everybody. Welcome to the May 19th, 2021 edition of Taxes in Retirement Live. I am Andy Panko, owner of Tenon Financial and admin/moderator of Taxes in Retirement. Thank you for joining me. We have a once a month mailbag edition tonight. Let me just dig in here and see what we got. I should actually get a mailbag, not a mailbox. And as you can see up here, where my mailbag? I am wearing my Texas shirt. I'm not from Texas. I did not go to school in Texas, but I visited there a couple times, liked it, bought a shirt. Why am I wearing it, you may ask? You may not ask, but I'm going to tell you anyway. I will be in Texas this weekend. I will be visiting a few people, one of which is the group's own Cody Garrett. Yes, so Cody, as most of you likely know, is the other moderator of Taxes in Retirement. Thank you, Cody. I will be going down to Texas. I will see him. I will see... looking forward to that while I'm there. I'm also going to be visiting Roger Whitney. You all may know him from the Retirement Answer Man podcast, and he's the founder of the Rock Retirement Club, which is a paid membership group he put together a few years ago. Great group, lots of good community and content. Well, anyway, I'm now one of the adjunct/faculty/coaches of the Rock Retirement Club. So I'm going down there to meet Roger, and I will be meeting a couple of my clients who are in Texas as well. For the rest of my clients watching, wondering why I'm not going to see you, my plan is to get there at some point. My clients are scattered throughout the country. It just so happens I'll be in Texas now. It's my first trip post-pandemic. I guess we're still in the pandemic, but first trip of the pandemic happens to be in Texas. So I'm visiting Texas clients while I'm down there. Go Texas. But I do plan on, eventually physically meeting all my clients at some point. All right. Before we get going, let me give you I'll do the dad jokes and the disclaimers. I do have 5 pre-submitted questions for tonight that I will address first. But let me do the dad jokes. I already did that one. Hold on. That's not very good. That was last week's. Can't be reusing that. That'd be weak. All right, here we go. Albert Einstein was a genius and worthy of praise and study. His brother Frank was an absolute monster. Frankenstein. Did you know that before crowbars were invented, crows mostly drank alone? It's kind of sad. They had nowhere to go. No watering holes to crows. And finally, never marry a tennis player. Love means nothing to them. Love, 0. Love, 15. Deuce, ace, whatever. All right, disclaimer, this video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I am some guy on Facebook answering live questions tonight and some written-in questions. Without further ado, I will get to it. And like always with these, if you don't mind, please... typically other watchers will, when someone posts a question, other people jump in and respond, which is normally cool. But for purposes of tonight in these mailbags, if I can ask you to hold off, so because it's tough for me to see the chain of who responds to what in my streaming service here. So if someone asks a question, just hold it. If for whatever reason I don't see it or don't get to it by the end of the night, then by all means jump in. But otherwise, please just let people's questions lie as they may be. All right, so I got 5, pretty long. I'll try to condense them. First one from Doug Stitch. I'm not going to read this whole thing. I probably should have did a spreadsheet for this to show it. But the gist is Doug has a pension that he's able to take in the form of a lump sum or a traditional, annuitized monthly payment for the rest of his life. Doug is married. He and his wife both have pensions that they can choose to take as lump sums or payments. So the question basically tax planning and Roth conversions. So Doug's analysis was if we both take the lump sums now, roll them into an IRA, traditional IRA, and then convert all of it, we're going to have a wallop of a tax bill while we're converting over the short term. But with that out of the way, sounds like there'll be minimal, if any, traditional IRA money left. And then when Doug and his wife are of Social Security age and start Social Security, none of their Social Security will be taxable because they won't have pensions or other income to pull their Social Security into taxation. So Doug's analysis basically came down to, okay, if I do this, take the lump sum now, convert it, pay the tax bill, it's going to be approximately $120,000 of incremental taxes over the next 10 years. But the payoff is that once he and his wife are 70, he anticipates he'll save about 15 grand a year for life from not having Social Security be taxed at that point, because he will have no other income. And again, Social Security be federally taxed at zero. So the question is, does that make sense to pay 120 grand now to save 150 grand, hopefully 20, 30, 20 plus years, assuming he lives into his 90s? And yes, that is the right way to start this analysis. And so, Doug, I do think your approach makes sense, and it is very sound. I'm not saying go ahead and do it. I can't give any formal advice here, but yes, you're thinking about this the right way. And that is the trade-off and the give and take and pros and cons you do with this longer-term tax planning. Now, the big wrinkles is that we don't know what's going to happen, right? Tax rates, we know, are going up. By how much and when exactly, that's all kind of to be determined. At a minimum, they're going up in 2026 when the Tax Cuts and Jobs Act expires. But I would bank on them going up sooner in some form or fashion prior to that. We also don't know what taxes will be like down the road in the future. My suspicion, pure speculation, but I'm thinking at some point Social Security becomes fully taxable to everybody, or at least more taxable than it is today. So, Doug, I'd say don't necessarily count on your Social Security not being taxed at all just because you have no other income in the future. Hopefully that's the case, but it may not be. With that said, even if that were to happen, does that mean that your big conversion plan now will have been a failure or the wrong move? I don't think so. You hear me say it a lot. I don't think anyone will ever regret converting or even over converting, unless it's so egregiously over converting. But if you're on the fence about should I not, leaning towards converting, I don't think the future you is going to regret. So that's my thoughts about that. Great question, Doug. Thank you for the glorious levels of detail, but you are going about it the right way, and I would think about it just like that as well. Next question, Lisa Percival. Another fairly long one. I'm trying to see if I can sum this up. So she referenced the Retirement and IRA Show, which is a podcast from Jim Saulnier and Chris Stein, one of my absolute favorite podcasts. It's very technical. It's kind of like taxes and retirement, super technical content, but explained in a digestible, fairly easy to understand way, and give away boatloads of content and knowledge for free on that podcast. I like to think of taxes and retirement like that. Maybe I'm holding myself up on too high of a pedestal, but that's kind of, if you like this Facebook group, you'll love the Retirement and IRA Show. Anyway, so the question was, see if I can sum this up. So Lisa thought she heard them say on the show that Roth accounts are included in the pro-rata rule. You have to add your Roth balances in for purposes of proration when you take out money from a traditional IRA. Long story short, no, it's not. There are no RMDs from your own Roth IRAs. Roth 401ks there are, but Roth IRAs there are not. If you inherit a Roth account, there are, you do need to take money out over a certain time, but typically there's no tax on it. But no, for purposes of the pro-rata rule on distributions from your own traditional IRAs, Lisa, what you do or don't have in your Roth accounts does not matter. You had asked, or someone else asked, okay, never mind, I'm confusing that. Someone else asked about Form 8606, which I'll touch on. So hopefully that answers your question, Lisa. I know I did get back to you by email as well, but no, Roth accounts do not get factored into pro-rata when you look at the rest of your IRA balances. Great question. Next question, Steve Wayne, about ACA and MAGI, Modified Adjusted Gross Income. Question is, so we have taxable account that is currently half bonds and half individual stocks. I'm going to retire at the end of this year. At 65, we plan to live off cash savings and the bonds for the next 5 years before starting both of our Social Security and a small pension at age 70. This guaranteed income will more than cover our needs. Great spot to be in, first of all. So must be a fantastic feeling, Steve. So the question is, my wife will need to be on ACA for 5 more years. We want to keep our MAGI low for ACA, but still find a good balance and do Roth conversions. Should we cash in the bonds to help lower our MAGI? I want to convert as much as possible, but still keep our ACA premium low. Any other suggestions for reducing MAGI? This is a prickly one. They directly conflict. Doing conversions and keeping MAGI low, literally the opposite. You do one, it's going to hurt the other, and vice versa. There's not an easy answer to this, and I get the question a lot from clients and people in the group. My response is it depends how much ACA credit you're able to get. Now, why do I say that? It's not the same for everyone. It depends where you live, what state you live, even what county you live in. It also depends the insurers and the policies available to you in that area. So you kind of have to shop around and see what would an ACA, Affordable Care Act policy cost full sticker price, and how much premium tax credit or subsidy am I able to get based on what MAGI I may be able to get myself to. And you have to weigh it. If you're only able to get $300 a month in ACA credits, then may not be that compelling to worry about keeping those ACA credits, especially if you can instead get ahead of tens of thousands or more of dollars in tax deferred account to move them into Roth, to get ahead of that now instead of letting the tax deferred money just grow and snowball. But if you're getting, I'm just making up a number, $1,000 or so or more per month in ACA credits, that's hard to give up. Bird in the hand, two in the bush kind of thing is worth two in the bush. Then you may want to consider, let's just massage our MAGI to keep it as low as possible to wring out as much, juice from this lemon as we can for these ACA credits and take advantage of that. Yes, we know we're further delaying the inevitable problem of having to pay potentially high taxes on our tax deferred balances. But again, $1,000 or more a month in ACA credits, that's hard to give up. Just to show, I have a quick screen share here about federal poverty lines and what your ACA credits are. Let me get my screen share here. Give me a second. All right, you should be able to see this. Yes. So this is from the government website, U.S. Department of Health and Human Services. This is the federal poverty line for a family of two, Steve. This is every state except Alaska and Hawaii. They have different, because they're higher cost states, they have different poverty levels. For the other 48 states in DC, the federal poverty level for a family of two is $17,420 of MAGI for 2021. Now, generally, you can have up to 4 times the federal poverty level and still be eligible for some sort of ACA credit. Let me just do the math here. So that would be just shy of $70,000 for this year. And I think it's just this year only under the American Rescue Plan Act that was recently put in place. You're no longer phased out at that four times federal poverty level. You still get some sort of credit, even if your MAGI trickles beyond that. At some point, it tapers off, but it's not a hard cliff anymore where it's like, you get nothing once you hit 4 times. So it depends how low you can massage your MAGI, Steve. And again, this is the lower 48 and DC. Alaska, for example, for a family of 2, the federal poverty level is $21,000 and change. So multiply it times 4. So that's what? That's like $86,000 roughly. Is the 4 times level. And then Hawaii is $20,040 for a family of 2. So anyway, so that's sort of the income ranges you're looking at that you may want to try to keep your MAGI within. How can you lower MAGI is your question. There's not a lot of options. Anything you realize as income, whether it's sell something at a capital gain, whether it's take a pension, take Social Security. Now, the MAGI for ACA credits includes the non-taxable portion of Social Security, so keep that in mind. It includes tax-exempt interest, like those from municipal bonds. There's not a lot of ways to massage MAGI. The typical deductions to MAGI are like IRA contribution deductions, but if you're retired and not working, you can't take advantage of that. HSA deductions, contribution deductions can help reduce MAGI. If you're self-employed, there may be some angles there, but outside of that, you really can't get your MAGI down. Once you have income, there's not things to offset it for MAGI purposes. So to answer your question, I don't know. It's art. It's a lot of art, more so than science, trying to figure out and guess and kind of deal with your own level of comfort. How much conversion am I willing to do, and how much MAGI am I willing to get, and how much ACA credit am I willing to give up? Not a great answer, but that's it. It's the truth. There's not a quantifiable way, because there's so much unknown about the future that we're trying to make educated guesses about, that makes this analysis difficult. But great question, though. Hopefully I at least gave you some food for thought there, Steve. But I can't pin a solid answer on that. All right, let me stop the screen share. Next question, Deanne Nielsen. Similar, okay, so not similar questions. I'm getting ahead of myself. So question was, she has a taxable brokerage account that has a fund that has relatively high fees. The company charges a 0.5% service fee on account balances, and the fund itself has a 1.2% expense ratio, so quite high. Add to it that service fee of 1.7% per year. That's extraordinarily high compared to most other funds and custodians. So the question is, I would like to roll that money into a low-cost index fund at Vanguard and get out of the 1.7% fee each year. The fund is a proprietary fund, so it cannot be transferred to a different company to even get out from under the 0.5% service fee. I know I can sell it, but then I have capital gains to pay, and that is not what I want to do because I do not want to increase my AGI for ACA health insurance reasons. Again, ACA kind of hamstrings people, unfortunately. Is there any way out of that fund that does not create a taxable event? Thank you. So that's the problem with these proprietary funds. Proprietary means, like, if you have an account, I'm not picking on Merrill Lynch, but I'm just making this up. Merrill Lynch, they may have their own funds, Merrill Lynch Mutual Fund, that cannot be bought at another broker or custodian, and similarly cannot be transferred to another broker or custodian. So you're stuck. You have to keep that account at Merrill Lynch, or if you really want out, you have to sell it. And when you sell it, you're going to realize whatever tax impact there may be from it. Unlike other funds, funds that are able to be held wherever, or single stocks, for example, if you own it at Merrill, you want out of Merrill, you can simply just electronically transfer that position to a new brokerage account at Vanguard or TD or Schwab or Fidelity. There's no tax implication to transfer it because you're not actually selling it. You're just moving custodians. But in this case, proprietary fund, you can't transfer it. It has to stay where it is, or sell it, take the cash and walk. So no, shy of selling it, there's no way out of it because it is proprietary. Now, there's a few other ways you don't directly benefit. One is you can just donate it to charity, right? If you're going to give away, $10,000 this year anyway, and let's assume this fund is $10,000, you can just gift that fund to a charity, gets off your hands. You don't have to worry about the tax impact, and it's gone. That doesn't directly help you. That helps the charity, but that's one way out of the fund with no tax impact. Another way is try to tax loss harvest. So what do I mean by that? So you have this fund. Let's say you have a $10,000 unrealized gain that if you sell out of that fund, you're going to have $10,000 of AGI, added to your tax return that year, which is going to reduce your ACA credit. If you have other positions you can sell that happen to be at a loss in a regular brokerage account, not IRAs, but another regular brokerage account somewhere, you can sell some of those other positions at a loss. Those losses will help offset the gain you'd have on the sale of this proprietary fund, and the loss will kind of wash out the sale, and only the net gain or loss is what will hit your AGI, Deanne. But if you don't have anything that's at a loss, that's not an option, unfortunately. You can just keep it, and deal with it. And the reason why I say that is, yeah, you're paying a 1.7% fee, which is redonkulously high for probably what it should be. But depending how much that equates to, if it's only a $10,000 position, 1.7% is what, $170 a year. Yeah, $170 a year. How much ACA credit are you getting, and how much would you give up if you were to sell this fund, realize the gain, and take the AGI hit, right? So think about it. Are you getting more ACA credit than you're paying in fee for this fund? If so, then maybe just ride this fund out with its silly high fee until you're done with ACA, when Medicare starts or whenever. Or if the fund, if the dollar amount of your position is at like $100,000, let's say, a 1.7% fee is $1,700 a year, versus in Vanguard it'd be whatever, $50, if not less. That's a big difference, right? And depending how much ACA credit you're getting, maybe it's worth just selling it, biting the bullet, losing some ACA credit for a year because your income is going to spike. And then after this year's over, then you'll go back to a lower income year, you'll get more ACA credit. That's the other option. Another thing, if it's a mutual fund, check how much gain you actually have. just so you know what you're working with. Just because you owned it a long time doesn't necessarily mean you would have a lot of gain if you sell, because mutual funds, if it's actively managed, and I'm hoping this is for a fee that high, it would have thrown off gains each year that you were taxed upon, and those gains would reduce, cumulatively kind of reduce the amount of taxable gain you have in the position. So perhaps you don't have that much unrealized gain to start with if you were to sell it. And so maybe this problem isn't that bad. So that's it. That's my thoughts on that, Deanne. Great question. Thank you. And final question for the evening comes from Teresa Wood, another Roth/8606 question. So question is, let's say I have post-tax dollars in my traditional IRA, but want to do a backdoor Roth conversion, assuming my employer allows. Assuming my employer allows, I roll over my traditional IRA into my employer's 401k. The next week, so the IRA is now zero. IRA balance is nothing. I assume that's what you're getting at. The next week, I make the post-tax contribution to my now empty IRA and immediately convert it to a Roth IRA. Does this timing actually bypass the pro-rata rule, or does the value of the traditional IRA at the end of the prior year come into play? How do I explain this in 8606? So I have, for your viewing pleasure, the 8606. So no, to answer your question, Teresa, if you do a conversion this year, any point in 2021, it's only your IRA balances at the end of 2021 that matter. Whether you zero them out today, zero them out next month, or zero them out on December 29th. I don't want to say 31st because I don't like cutting things close. Or let's just say December 20th. So long as you get the entirety of your IRA balances into your 401k before the end of 2021, any conversions you do via the back door, meaning you put in a non-deductible contribution, immediately convert it to a Roth, pro-rata rule will not come into play for you. And how do you see this on the 8606? Well, long story short, if you look at this row 6, it says enter the value of all your traditional SEP and simple IRAs as of December 31st, 2020. This is last year's 8606, which is why it says 2020. But for this year coming up, it'll say 2021. So this is where pro-rata, the calculation starts. You put in your IRA balances, all IRA balances as of December 31st of that tax year. And then follow it through, and then it applies pro-rata to that. So long as these are zero by December 31st, meaning you roll them into your 401k by then, you're good. You won't have them muddying up pro-rata for your backdoor Roth contribution that you want to do. Cool. Good question. All right. I shall stop this screen share, and I'm back. So that's it for the pre-funded questions. Thank you all for that. Let me get a little sip here and then start at the top. And I'm back. Okay, starting with Facebook user, tax question. For the purposes of earned income needed to qualify to contribute to an IRA, if I have self-employment income, do I count the whole thing as earned income, or do I have to deduct my expenses? Will this also be the case for a single member LLC? Great question. Yes, so you deduct your expenses. It's the net amount of income that you show from the business as shown on your Schedule C. I forget what line it is exactly, but yeah, it's net of depreciation, it's net of utilities, it's net of licensing and fees, whatever. That's your earned income. Maybe slightly different. You may also have to deduct some of the payroll taxes you pay, the Social Security, Medicare. So don't quote me, it's one of those. But the point is, it is net of expenses. It's definitely not the gross amount. Same case for single member LLC. Whether you operate your business as a sole proprietor or as a single member LLC, it'll go through Schedule C just the same. The math and the formula works out just the same. Great question. David Foltz, how do you feel about a gradually increasing stock percentage as one ages in retirement, say starting at 40% stocks at age 65 and allowing it to gradually increase? So this is called great question, David Foltz. This is called the glide path, the reverse glide path. There is literature and studies on it that says hypothetically this could and should work. Now, who knows what the future holds? This is all just predictions based on the past, but the theory is that the earlier years of retirement is when sequence of returns matters the most. A string of bad years of market returns in early retirement could do some irreparable damage to your retirement portfolio. So you don't want too much of your portfolio in risky stuff like stocks. 60%, the good old-fashioned 60-40 stocks to bonds could and should work. If you go 70-80% stocks, that can be bad. If stocks drop 50% like they did in the 08-09 crisis, that's not good. So the logic is you keep a more relatively modest stock allocation early in retirement, ride out those first few years. When you get towards the later stages, sequence of returns matters less. In theory, you have spent down most of your portfolio already. So losing 30% of a relatively small amount isn't that big versus losing 30% of your starting nest egg is a lot of dollars. So the logic is that actually ramp up stock exposure over time because you're less susceptible to the long-term impacts of sequence of return risk because you're not so long-term anymore. Your life is approaching its endpoint with every year that passes. So I've seen the literature. It works in theory. I can't see doing this in practice. Imagine telling someone who's 70, 80, 90, yeah, let's ramp up your stock exposure. Now, if they have so much money at that point that there's like virtually zero risk of them outliving it, then sure, maybe you do it, not for them, but for purposes of maximizing what's going to be left for the eventual heirs. Because if someone's 90, doesn't spend much, and has $2 million, they probably don't care. They're not going to want to go crazy with the risk for their own benefit. If anything, just park it in cash, and that should do them just fine, frankly. But if they want to maximize what's left for heirs, then you dial up the stock. So I don't know, defaults. I get it. It could work. I just have a hard time seeing anyone really being cool with that in the later stages of life. Being like, yeah, let's really ratchet up the stock exposure. June Wang, C. Don't know if you're meant to type something here, but hi. Brad knew it. I purchased some mutual funds over the years and have sold some of the shares as well using a cost basis calculation of average cost. Can I now change my cost basis to something different like first in, first out before I sell shares again, or am I now locked into average cost? Yeah, good question. I don't know. You have to ask the custodian. In theory, you can. In practice, custodians may limit you, possibly. I'm just thinking out loud. I don't know any that do or don't definitively. But you'd have to ask and see what they say. It should be a simple enough question for them to answer. I don't think the IRS prohibits it, which is why I'm saying in theory you can, but the custodian possibly may. At least that's my guess. I don't know definitively. Linda asks, is there a way to contribute directly to a charity from an IRA if at least 59.5, but not yet 70.5? No, next. Just kidding. Not to be jerky. No, there's not. So what you're referring to is a qualified charitable distribution, which is where you send money directly from your IRA straight to a charity. Does not go through your hands. There's never a distribution to you directly. No, you have to be 70.5 to do that. Not even the year you're 70.5. You have to actually be 70.5 to do that. You cannot do it prior to then. So no, Linda. Facebook user, if you get a 1099 with section 199A dividends but don't have a business, can you still take the QBI deduction? It's from REITs and a mutual fund. Yes, I've seen it all the time in doing tax returns and seeing clients 1099s. REITs are the dividends thrown off by REITs are eligible for the 199 cap A deduction. Basically means that you get a tax deduction equal tax credit equal to credit equal to 20% of the dividends, the qualified dividends from the dividends from the REITs. So yes, and any tax prep software you have should automatically do this for you. Whoever asked this question, good question. Teresa Wood. Oh, thank you for the 8606 answer. I'm glad you're excited. Triple exclamation point and 4 H's. Thank you, Teresa Wood. Oh man, looks like we're out of We're out of questions. One more here, from what I see. Mary Sherwin, can you explain the one-time HSA contribution you can make from your traditional IRA? Yes, I can. So, I did this with a client a few months ago. Let me remember. So the IRS allows you to do once in a lifetime. You can do a transfer / rollover, however you want to call it, from your traditional IRA into your HSA. Why would you want to do that? Well, it'll help reduce your your IRA balances. Assume your IRA is all pre-tax money. That's all money that's going to be taxed at some point when you take it out. You can just shift, some of it over to your HSA once in your life. You now get that money out of the always going to be tax world into the hopefully never tax world of HSA, assuming you eventually take the money out to pay for qualified medical expenses. Now, there's a few things to watch out for here. You can only do it once in your lifetime. You can only do it up to your annual limit, your HSA contribution limit. I forget the exact amount. It's like $7,000, $7,100 maybe for family coverage, half of that for single coverage, plus $1,000 extra catch up if you're either 50 or 55 or older. I knew all this at one point, but I forgot. 50 or 55 or older. You could also only transfer. So let's assume your limit's 7,000 contribution for the year. You already put in 5,000 by some other means. You can only do another 2,000 from your IRA that year into your HSA. So you can't exceed your annual HSA limit under any circumstance with this for the year. The other rub is that when you do this, you need to continue to have qualifying high deductible health plan for the 12 months after the month of your contribution. So if you do this IRA to HSA funding thing in December of 2020, for example, you will need to have a qualifying HSA eligible high deductible health plan for the entirety of 2021. If you don't, then that distribution can be retroactively deemed excess, and there's a tax and or penalty on it at that point. So this it's a cool little trick. It's not life-changing. It's not going to dramatically alter the health of your long-term financial plan, but can't hurt to do it if it makes sense for you. And again, if you're going to have coverage for at least 12 months after the month you do this thing. Hopefully that answered your question, Mary. Cool. All right. And it's called a qualified HSA funding distribution. A QHFD is what you may see it referred to as. For Linda's question, could she use a donor advised fund? So this is going back to Linda's question of, Linda has an IRA, wants to know, can I donate money directly from the IRA to a charity? No, prior to 70.5, you cannot. So the Facebook user says, can she use a donor advised fund? Yes and no. A donor advised fund can't be funded with IRA money. So no, you can't directly do it that way. What you can do is take a distribution, but that distribution is going to be included in your AGI. Like let's say you take $50,000 out of your IRA, that's $50,000 of AGI you now have. You can then turn around and yes, you can take that $50,000 and put it into a donor advised fund. That donor advised fund contribution will give you a $50,000 charitable deduction for the year, such that all else equal, assume you have no other income or anything, you will have zero taxable income for that year. But you still have AGI. Why does this matter? Because there's other things that are keyed off AGI, like Medicare premiums, like ACA credits or lack thereof, like how much of your Social Security is taxable, keys off your AGI. So one extreme, let's assume you pull out 300 grand from your IRA, Linda, and then turn around, take that 300,000 in cash, put it into a donor advised fund. Your taxable income is going to be zero. Sounds good so far, but you have $300,000 of AGI. If you're of Medicare age, guess what? Your Medicare premiums are going to spike in 2 years because it's going to see you at $300,000 of AGI. If you're getting ACA healthcare credits, those are going to go away if you have $300,000 of AGI. So that's what you have to look out for. What you're describing here reduces taxable income, but does not reduce gross income. That's the difference. Whereas with the qualified charitable distribution, when you're 70.5 or older, donating straight out of your IRA, that doesn't hit your AGI in the first place, so it doesn't mess up these other ancillary things like or Medicare surcharges or ACA credits or whatever. Great observation, whoever this was. I received a 5498 from Vanguard this week. What do I do with it? Probably not much. So honestly, this is what's kind of annoying. Tax returns are typically due April 15th, right? This year's an exception. Last year's an exception, but normally April 15th. you're allowed to make contributions to IRAs or Roth IRAs for the prior calendar year up until the tax filing deadline of April 15th. So 5498 is a form that just shows all the contributions and year-end balances of your IRAs and Roth IRAs. Why do brokers not send them out until after tax returns due? Well, because you can still contribute to your IRA up until April 15th, for example. So they can't send you out to 5498 until April 15th already happens. So fast forward a week or two, now you get to 5498. Do you need to do anything with it? Depends. If the 5498 is what's going to show your end of year balances, like I said. So if you did Roth conversions last tax year and you have to worry about the pro-rata rule in the form 8606, you're going to need to know your end of year IRA balances. That'll be on your 5498. Now, practically, you can kind of just take them off your end of year statements. They should be the same number. Just trying to think where else this can potentially cause trouble. It'd be good practice to wait until you get your 5498 to actually file your return, which basically means you have to file an extension. Do you really have to do that? I don't know. Don't consider this formal guidance. In many cases, I don't think you have to wait for the 5498. The problem would be the IRS gets a copy of that. And if the custodian reports something erroneous on the 5498 and you already filed your tax return based on the accurate info, well, guess what? It's not going to jive with what the IRS shows. Then you may have an issue on your hands. So that's why I'm saying it's best practice to wait to do your return until you get the 5498. But you can probably get away with filing your return early, as in the case you did, and then you get the 5498 and you just simply, keep it in your records and hope nothing comes of it. So, good question. Mr. Fultz again, what would the advantages be if the RMD age is raised to 75? Yeah, I don't know. I've been thinking about this since it's been kicked around as part of Secure Act 2.0. I really don't know the reason. I mean, as the individual with the accounts, the benefit is you're not forced to start taking money at 72. Now you can delay till 75, but I don't know the upside, right? You're just, the downside of tax deferred vehicles is you're not getting rid of tax. You're just delaying it. You're just kicking it down the road. So delaying the RMD age, all that's doing is just kind of punting the inevitable further down the road. So I don't think it's great, honestly. I guess there's scenarios where, yeah, in some people, for whatever the combination of reasons may be, it's beneficial to them, for them in their scenario. But on the surface, I'm not that concerned with RMDs. Again, it's just delaying the inevitable. So whether you take them at 70, 72, 75, I'd have to think about this more. And I've tried, but I've struggled to come up with like a solid answer that gives me a lot of conviction one way or the other. I don't think it's a big deal, Dave Fultz. I don't think it's a big deal if they stay at 72. And I don't think it's a big deal if it gets moved to 75, is my opinion. Now, for what it's worth, I'd kind of like to see RMDs go away, but the issue is, and I fundamentally agree with this, as much as it's my job to help people minimize taxes, I like to think I'm practical and kind of see both sides of every story. The intention of IRAs wasn't to accumulate a lot of money to pass on tax efficiently to your heirs. It was not intended to be a wealth transfer vehicle. It was meant to be a vehicle for you to save, for you to supplement your Social Security and or pension or whatever for your own retirement. It doesn't mean you have to spend it all down during your life, but it wasn't meant to just sit there, accumulate, and pass on to heirs who are hopefully in a lower tax bracket than you. That's why RMDs are there. The IRS gave you the tax break initially, or let you defer the taxes. You got to pay the piper at some point, so they force you to start taking money out. So anyway, I don't know where I'm going with that, but I don't personally think it's a big deal either way, Dave Fultz. But I know some people have strong opinions about this and other tax matters. Follow up to the IRA to HSA question from Ed. Can I withdraw from the traditional IRA and then make a contribution to the HSA in the same amount? Sure. So long you can only contribute to an HSA if you still have a qualifying high deductible health plan. If you don't, then no, you can't contribute to an HSA under any circumstance. You have to be currently covered by a high deductible health plan. If you are covered, sure, money's fungible. Whether you take money out of your checking account, whether a friend gifts you $7,000 that you turn around and put into your HSA, whether you take a distribution from your IRA, turn around and put that into your HSA, it's all the same. cash is cash. Where it comes from doesn't matter. You're putting cash into an HSA as the end result. Yes, in this case, the contribution to the HSA will be deductible. So it would lower the increase in AGI you'd otherwise have from taking the IRA distribution in the first place. Ed, good question. So it's like a zero-sum game tax play here to do this. Facebook user, what should we do in a situation where traditional IRA contributions were made for years, decades, but no deduction was taken, though income was below the limit and no 8606 filed? Try to fix it with amendments, or 18606 or 18606 per year. So 8606 wouldn't be the solution. So you basically, I guess, mistakenly did yourself a disservice in that your tax bills for each of the years you made these contributions should have been lower than they were, because you did not give yourself credit for deductions you were able to take. Now, you cannot go back more than 3 years and amend a return for additional refund. So contributions you made 10 years ago that should have been deductible and you mistakenly missed a deduction, it's gone. You can't go back and redo that at this point. But you can still amend 3 years back. So 2020, 19, and 18, you can't do 2017 at this point. So you can still amend the last 3 years. And if those amendments do, sure enough, free up some refund because you give yourself a little bit more deduction, then sure, go ahead and do that. You have to weigh the cost. Are you doing the amendments, or are you having a tax return preparer do them for you? How much is it going to cost you to amend the returns versus how much tax refund you're going to get? Is it worth it? That's the break even for you to do. As far as 8606, so you didn't file any. So you basically want to true it up. So let's assume you did 20 years of IRA contributions, all of which should have been deductible, but you never actually took the deductions. You never filed 8606s. You can amend the last 3 years of returns. No more. You can't go back further than that. And then you can do an 8606 for this year, starting fresh, saying, okay, I made 20 years of contributions, 17 of which were non-deductible. So that's your quote unquote basis. You would want that documented in 8606. Don't quote me, but that should be the only change you have to make to start in 8606 going forward, is add up your 17 years of non-deductible contributions. Again, I'm saying 17 because I assume you did contributions for 20, but that you're going to amend the last 3 to get your refund. The other 17 you can't amend, so you just have to consider that basis. You took no deduction for it. Does that answer your question? If this sounds more technical and kind of clunky than you're comfortable doing, definitely reach out to tax return preparer. Now the tax season's over, except for people in Texas, parts of Louisiana, Tennessee, and somewhere else. Tax season's over, so hopefully tax return preparers have some breathing room and could help you with this. Good question. Brad again. If Brad takes money out of a Roth IRA before age 59 and a half, Brad pays a 10% penalty and Brad pays taxes on any gains that Brad withdraws. Correct. Are those gains taxed as normal income or as long-term capital gains? Oh, Brad, I recognize this question from New Retirement, I believe, 457s. So before age 59 and a half, yes, you will pay a 10% penalty on any gains you withdraw. And yes, you'll pay tax on any gains you withdraw. The gains are taxed as ordinary income. They are definitely not taxed as the reduced long-term capital gains. Same story applies to 457s. I know I botched that answer a little bit, Brad, in New Retirement. Sorry. For 457s, the 10% penalty would not apply, but the tax on earnings would. Or was it only 5 years? I'm not a 457 expert, so let me stop talking there before I mess that up again. But in Roth IRA, I know it's with certainty. Yes, penalty and taxes on interest on gains if you take it out before 59 and a half. Gains are taxed as ordinary income. Yeah, done. And for what it's worth, I think we touched on this in the other post in New Retirement. There's an order of distributions. Any dollars you take out of your Roth IRA are deemed to first come from the amounts you contributed. Only if and when you take out all of your cumulative contributions, then the next dollars of withdrawals are deemed to come from any conversions you did. If and when you then take out all conversions, only then are you deemed to be dipping into removing gains, Brad. Hopefully that helps. When is a good time to open a Roth for a child? As soon as a child has earned income, because you need earned income to be eligible to open a Roth. Now, I don't know the specifics. It gets it's a little gray. If you can employ your child, not just for doing household chores, but I looked into this once and only vaguely remember it. You can basically employ your child. You don't have to have like an actual business. You don't have to withhold payroll taxes. And that employment could count as earned income for purposes of your child being able to open a Roth. But let me stop there. I know enough to be really dangerous about this. That's something to look into, is the rules around giving work, household work to your child to have the child get some income from you and have it be considered earned income so the child can have an IRA opened. Now, you'd have to open it as a custodian because the child's a minor, presumably. So you'd be opening the account on the child's behalf. But yes, that is possible. Cody Garrett, I will see you on Saturday. Cody Garrett, looking forward to some serious barbecue. Which financial planning topic areas do you consider to be the most valuable yet underestimated by families who are nearing retirement? Oh man, that's a tough one, Cody. Come on. Too open-ended. I'm not good at open-ended. For families who are nearing retirement, I don't know. I'm stumped. I mean, I lean towards taxes, obviously. So I'm going to say things like, too much tax-deferred money in IRAs or whatever, not being aware of things like IRMA, like ACA credits, like how expensive healthcare is. Once you leave your employer, you may not realize it, but employers heavily subsidize your health insurance. Most people are aware of COBRA, that allows you to extend your employer coverage for up to 18 months after your termination or separation service. But COBRA, you pay full sticker price plus 2 or 3%. When people see COBRA prices, they're taken back at how expensive it is. And only then do they appreciate how much their employer was subsidizing along the way. That's a big one. Outside of that, I would need to give some thought to this, Cody. Great question. I just don't have a well thought out answer about this. Sorry. Thanks, Cody. Facebook user, a question regarding 457s. Do you have to cash out entire amount once you leave the employment, or can you cash out fixed amounts to avoid high tax? I frankly don't know. I'd say ask the employer and see. I would assume they would allow something other than all or none distributions, but I really don't know. If it's anything like a 401k, I know it's not, but I'm just thinking out loud. If it's anything like a 401k, each employer is allowed to structure its plan how they choose. I've seen plans where once you leave, you can only take one distribution and that's it. So that basically means it's all or none. I've seen other ones where it's like you can take one distribution per quarter. Other ones have much more flexibility. So my guess is it really all depends. You'd have to ask the employer or the school district or the whatever hospital system, wherever you work, and find out, see what they say. Okay. 3 or more years to convert. I assume this was a response to someone else. This was about RMDs. I think Uncle Sam wants the taxes to be paid now to help reduce debt. So yeah, this probably goes back to RMDs. That's why the government wants RMDs, because they want you to pay tax at some point and not defer it indefinitely. So they'd prefer it sooner rather than later. Whether 72 or 75 is the right number, I don't know. Mary, again, did I read correctly that your HSA balance is immediately taxable to your beneficiary when you die? Ooh, that's a good one. I'm considering making a charity my HSA beneficiary if that's the case. Yes, great point. Thank you for bringing that up. So an HSA is one of the best tax-advantaged retirement savings vehicles there are. Tax-free on the way in. All the growth is not taxed while it happens, and tax-free on the way out, assuming you use it to pay qualified medical expenses. That's better than Roths. Roths, you pay tax up front, but then it gets the other 2 tax benefits. And IRAs are flip-flop. You don't pay tax up front, but you pay the piper at the end. So HSAs are the most tax-efficient investment type account there is. If and when you die and you're married, your spouse can pick up and run with your HSA where you left off. So he or she can then use it tax-free for the rest of his life or her life to pay for qualified medical expenses. If your spouse dies or you're not married and you die, then yes, anyone else who inherits an HSA needs to fully distribute it. I believe it's in the year of your death, and it's all taxed as ordinary income to that person, all of it. So that's far from ideal to leave as an inheritance or a wealth transfer tool, unless you leave it to a charity, in which case, just like you said, works out perfect. The only one that loses is the government. The charity doesn't pay any tax on it. You don't, your heirs don't have to worry about it. Leave your heirs something else, like a Roth IRA or like regular brokerage assets that get a step up in basis. If you can control it, don't leave your heirs, other than your spouse, your HSA, because the tax impacts of inheriting HSA are far from great. Great comment there, Mary. 529 question from Facebook user. In order to use 529 funds for room and board, does it have to be on-campus accommodations, or could it also include a home that you either rent or own? And is there a limit, like having to use what the college says and the cost of attendance? That's a good one. I looked this up twice in the last year. I forget the answer, and I'm not a college expert, but I do have clients who have 529s. So where, if I remember correctly, if you own the home, like some people say, let me buy a house in my kid's college town so the kid can get residency there, live there, pay me rent, kind of everybody wins. So they're paying in-state tuition. I get some rent. They get somewhere to live that's hopefully cheaper than room and board, and use a 529 for it. If I remember correctly, you can't do that because it benefits you. You as a property owner, you're in effect paying yourself back, which is a no-no, if I remember correctly. I do believe you can use it for off-campus housing that's not owned by you or you otherwise don't have a direct beneficial interest in. It does not need to be just the dorms on campus. I'm fairly confident about that. But again, when you own it or have some direct interest, that's where I think it's a no-no. And is there a limit? As far as the limit, again, I looked this up. I think the answer was yes. I believe the amount of off-campus housing you can deem eligible for 529 withdrawal is no more than the college's advertised or published cost of attendance, housing cost of attendance. I think. Don't quote me, but I'm fairly confident that that's the approach there. For what it's worth, I had a client ask me this: what if you end up using 529 funds? Like your kid graduates college, you have nothing to do with them, you don't necessarily want to give it to someone else. Can you use it for other things? The answer is yes. But you can always, your contributions that you put in are tax and penalty free when you take them out. But any earnings you take out to use for anything other than qualified education expenses, not only are taxed as ordinary income, but they also have a 10% penalty. So not great tax situation to use 529 funds for something other than qualified education expenses. Now you can use them yourself for education. You can give them to other family members, friends, whatever. Basically gift it to people if you want. But for you to use it for anything other than qualified education expenses, there is a relatively steep and punitive tax and penalty on using the earnings in there. Canon, the advantage of moving RMD to 75 is for heirs if the individual dies before they reach 75. Yeah, good point, I guess. I mean, there's that much more that the person will get. But you also have to look at like tax rate arbitrage. So if there's a couple, elderly couple who's in a low tax bracket and their heirs, their children are in their peak earning years in their 40s, let's say, and the couple knows that most of their money is going to end up going to their kids, their heirs anyway, it may be worth it if the couple's cool with it for the couple to consciously take distributions from the tax-deferred accounts, pay taxes at their relatively low tax rate, and then just turn around and pump that money into a regular brokerage account or whatever, or just let it sit in the bank, so that when the heirs eventually get it, they won't have to pay tax on it, right? Because let's say the heirs are in a 30% tax rate, the couple's in a 20% tax rate, so there's a tax arb in wealth transfer. It'd be better for the couple to pay 20 as opposed to pay nothing, pass all the money on to the kids. We're going to have to pay 30% tax on it. So yes, I agree with what you're saying, Cannon, but it's not quite that simple. Maybe some people actually want to pay taxes on behalf of their kids to maximize how much net money is transferred, net of taxes. Cody, good point. So Cody, I guess this was in reference to, can you take money out of an IRA and contribute to an HSA? Great point. Once you're on Medicare, no, you're no longer eligible to contribute to an HSA because Medicare is not qualifying high deductible health plan. So once you're Medicare, boom, no more HSA contributions for the rest of your life. You can still have an HSA and take money out, assuming you funded it before, but you can't contribute beyond that point. Andy, where is the new retirement site you referred to? So there's a Facebook group called New Retirement. Was it Bill? Bill knew it? Ben? Bill? Brad, sorry. So Brad asked the question, the New Retirement Facebook group, about Roth 457 withdrawals, and I messed up the answer, which thankfully someone pointed out, and I edited and corrected my answer. But anyway, so New Retirement is it's a consumer-facing retirement planning tool. There's a free version. I've never used it myself. The free version's fairly comprehensive, but then if you want additional features, those are at a premium. Then there's subscriptions that there's service you pay for to unlock access to more bells and whistles. But there's a basic free retirement planning software available by a company called New Retirement, and New Retirement has a Facebook group called New Retirement. Bill Hitz, knowing your expenses down to the penny. Not sure what this is reference to, but yeah, expenses are important. If you don't know what you have to spend, you don't know what income you need. And that's, the expense part of the equation is as important as the income part, because you can't do one without the other in mapping out a retirement plan. Facebook user, if you have the ability to contribute to a Roth 401k at work, what's the benefit of doing this over opening a brokerage account and contributing the same amount to that instead? Other than company match, doesn't a Roth 401k just add rules to your money in the long run? Sort of. In the intermediate run, it does. So Roth contributions and regular brokerage contributions are after tax just the same. Agree with you there. While you're younger than 59 and a half, the brokerage account has more flexibility because you can access it whenever. The downside is any interest or dividends or capital gains within that brokerage account are taxed along the way as they happen. Whereas within the Roth, nothing is taxed along the way. Whatever gains, losses, interest, dividends you have, it all just stays in the account. There's no tax impact. Where the Roth really shines is longer term. It is designed to be a longer term retirement planning tool. Once you hit the point where your withdrawals are qualified, meaning the account's at least 5 years old and you're 59 and a half, then all monies come out tax and penalty free, not just your contributions, but the gains as well. That's where a Roth really beats a taxable brokerage account. But yes, along the way, you could be in a position where if all your money's in a Roth, you might be stuck. Now, you should be able to access your contributions out of your plan at any time with no tax or penalty if your employer allows it. But the gains, that's a different story. Tax and penalty on that, whereas a brokerage account does not have a penalty, and the taxes may not be much depending what you're selling to get it. So pros and cons either way. Longer term, Roth is probably the better option, but intermediate term, sure, regular brokerage account could be more advantageous. Okay, so this is in response to the question on 457. I guess you're saying this particular person's plan allows them to take their money as they need it, as opposed to all or none distribution. Yep, Cody's just saying with any employer plan, ask about their summary plan description. That'll outline the details of what you can and can't do. Although it's not in full detail. So I just looked at, for what it's worth, Cody, I have a client, husband and wife, looking to do Rule 55 withdrawals. Looked at both their 401k plan descriptions, and all the description said was Rule 55 withdrawals are allowed. They made no mention of the frequency or the size or whatever. One of them did say, I think it had to be at least $300, but it didn't say like, can you take it out daily, monthly, quarterly, once a year? So that was kind of annoying. So I guess you have to call up the plan and see what they actually allow. But the summary plan description did not have that level of detail. Tressa Wood, thank you, Mary Sherwin, for a great question about HSA balance. No spouse and have not yet spent any of your HSA. You're gathering qualifying bills, but that would be a headache for the heir to submit those expenses to reduce their tax burden, or the tax benefits totally wasted if they don't bother. When to spend the HSA dollars if they weren't needed at the time of the expense. Yeah, the goal with an HSA is you want to kind of ideally have it over your working years, contribute to it, invest it for long-term growth so you can save it when you're 60, 70, 80. And then use it at that point to pay for whatever medical expenses you have, so you can get a lot of growth along the way. So the goal is to try to like save it and maximize it, but not have too much left over, because again, you don't want to leave it to a non-spouse heir, because it's not tax efficient at all to do that. If you know with certainty when you're going to die, this is easy to do. But you know, that's like any aspect of retirement planning, is trying to put educated guesses to things that are kind of really hard to try to guess, like when you anticipate passing. But yeah, great observation. June, follow up on designating charity for HSA. If I leave HSA in a trust and children as beneficiary for the trust, but designate charity for HSA, can it be tax deductible for children? Hold on, I have to wrap my head around this. If you leave a HSA and leave a trust as the beneficiary and children as beneficiary of the trust, but designate within the trust a charity as a beneficiary for the HSA, can it be tax deductible for children? I don't know. This sounds hairy. I'm just guessing. I don't know this for certain, but you generally don't want to leave qualified assets like IRAs, 401ks, and presumably HSAs to a trust, because then you run the risk of the trust having to pay tax on the inherited account, and trust tax rates are really bad. I'm not an expert on trust. I don't know if there's a way to word or structure the trust to avoid this. So I'd probably say, again, not specific advice. You'd have to ask a trust attorney about this and stuff. Ideally, one who knows about HSAs. But I'd say it's probably ultimately easier and safer to just circumvent the trust on your HSA. Just name the charity directly as the beneficiary of that HSA. That's my guess. Again, don't quote me on that. But the trust thing sounds like it's asking for more trouble than maybe worth. Tao, does the 5-year rule restart when you roll over a Roth from another brokerage? Can you withdraw contributions anytime after 5 tax-free years? No, the 5-year rule does not start. It's based only on January 1st of the year in which you open and fund your first Roth IRA. So let's say you opened one 20 years ago at Vanguard. You've since transferred it to Fidelity, transferred it to TD, transferred it to Schwab. All that doesn't matter. You met the 5 years because you opened it 20 years. Your first one was opened 20 years ago. 5 years is done. You're never going to lose that clock, the progress toward that clock. Can you withdraw contributions anytime after 5 years tax-free? So I'll do you one better. You can withdraw contributions anytime, period, tax and penalty-free. That's money that's already been taxed, so you're not clunked on the head again a second time with tax when you take it out. So you can always take out your contributions from Roth tax-free at any time. You don't have to wait 5 years. The 5-year thing only comes into play when it comes to taking out gains and potentially conversions under a separate 5-year rule. But no, good question here. Ed, thank you. So yeah, Ed shared the new retirement website. All right, looks like we are coming to the end. What was the entitlement IRA podcast you mentioned earlier? Sorry, I got to take better notes. Yeah, so it's called, Retirement and IRA Show, not Entitlement and IRA Show. Let me just I'll find the website so you can see IRA Show. Absolutely fantastic show. I've talked to these guys a handful of times. Jim, Saulnier, and Chris. We think alike, partly because I consider Jim one of my mentors and learned a lot from his show, frankly. So let me get my screen share here. So the Retirement and IRA Show, here's their website, theretirementandIRAshow.com. This is a podcast that's been around many years. These guys had a local radio show. They're in Fort Collins, Colorado. They've had a local radio show for well over 10 years. And at some point, they started running that show on a podcast. They since stopped doing a live radio show. Now it's podcast only. But they do 2 shows a week. One is a general Q&A, kind of like what I'm doing now. And another one is what they call EDU, or education. It's a deep dive into one particular topic. They get really in the weeds, which is really cool. Some of it's, it gets dry, but it's super, super valuable education for those that are interested in this, really good level of depth. So yeah, Retirement and IRA Show. This guy, Jim here, is awesome. I like him a lot. Chris is cool too. All right. What else do we have here? This person likes that show, and I've learned a lot over the years, as have I. I'm not ashamed to say I've learned a boatload from these two guys. I highly recommend anyone who's interested in a great level of education and depth about all this stuff we talk about in taxes and retirement. Definitely put this podcast on your whatever you call it, on your playlist. All right, I think we got one more question here. Inside joke. Hold on. Chris goes into the rabbit hole. So yeah, this guy, Jim, he talks a lot. I'm kind of wordy. Jim's wordier than I am. And they make fun of each other. Chris is really short and to the point. Jim, not so much. And they always have this running joke that Jim makes fun of Chris for talking too much and not being pithy, as Jim puts it. Okay, well, what was this question here? Let me get the screenshot. So what is a disclaimer trust used, and is it a good idea? I don't know. Disclaimer trust. I think I may have heard of it. I don't know what it is. Is this like a see-through or conduit trust where you can leave a qualified account like an IRA to it and it passes through to the heirs without the trust having to pay? I don't know. Sorry, Joel. I do not know, because I don't even know what a disclaimer trust is. Someone just brought up an IRA trust the other day, a retirement trust. I wonder if it's the same thing. But yeah, I don't know, Joel. Sorry. All right. Looks like this is the last question. If anyone else has one, feel free to throw it in. But otherwise, this is the last one I see. I have a SEP IRA to which I added non-deductible IRA money a few years ago. Is there any way to separate pre-tax and post-tax money? Can you even do non-deductible to a SEP? Yeah, I guess so. I never thought about it. Is there any way to separate pre-tax and post-tax? So yes, sort of. This is called cream and coffee, and that's I learned this analogy from the Retirement and IRA Show, actually, and they learned it from Ed Slott, I think. So this is the whole idea of the pro-rata rule. Pro-rata is you have an IRA, some of the money is pre-tax, traditional pre-tax money, some is post-tax. Once you have pre-tax and post-tax money mixed, you can't cherry pick out, okay, I want to take out just pre-tax, just post-tax. Think about a cup of black coffee. Pretend this is a mug. In it, I have pure, unadulterated black coffee, right? The color is black or dark brown or whatever it is. I put in a splash of white milk. Once the milk is in, swirl it around, this black coffee now becomes like this brownish mocha color. These two things are inextricably mixed. I can't go into this mug and now pull out, just a spoonful of the milk I poured in, and I can't pull out just a spoonful of the black coffee. It's mixed. It's this inextricably slurry mix. Any sip, any spoon you take out now is going to be, 90% black coffee, 10% cream. You can't cherry pick what you choose. That's the pro-rata rule. Whenever you take money out of an IRA, it's going to be prorated parts of pre-tax money and post-tax money. There is a workaround to try to filter out the pre-tax and post-tax. Will it work with the SEP? In theory, yes. I've never tried it. But basically, if you have access to an employer plan like a 401k, and if that plan allows you to reverse roll in money from a IRA or a SEP IRA, upon that rolling in, the 401 should be able to filter and sift out the coffee from the cream. Because within the 401k, there's a pre-tax account, there's an after-tax account, there's a Roth account. In pushing that rollover into the 401k, the onus is on the 401k administrator to backtrack the records and basically split apart. Take the black coffee, put it into the traditional pre-tax 401k pot, take the white cream, put it into the Roth pot or the after-tax pot. That's the way to split it out. It only works if you have an employer plan and an employer plan that allows it. whoever this person is. So you'd have to look into that. But in theory, yes, it's doable. Outside of that, no, I'm not aware of any way to separate the cream from the coffee, or the pre-tax and the post-tax money in a SEP or traditional IRA. What is this? Bruce, don't know if this helps, Andy. This is in reference to the question on the disclaimer trust. A disclaimer trust is a clause typically included in a person's will that establishes a trust upon their death, subject to certain specifications. This allows certain assets to be moved into the trust by the surviving spouse without being subject to taxation. Same as a revocable trust, question mark. Oh, yeah, I don't know. Still not ringing a bell. I've heard of a pour-over trust, or testamentary trust. It's a trust that's created by way of the will after your death. I don't know if this is one and the same as a disclaimer trust, or a disclaimer trust is a special type of pour-over testamentary trust that does certain things, like allows a spouse to not be subject to taxation. Interesting. If that's, I'm not familiar with this, but that sounds like a cool trick to look into. Thank you, Bruce, for that. Can SEP IRAs be rolled into a solo 401k, or is this determined by the solo 401k plan? Yes, it'd be determined by the plan. So like, I have a couple clients that have solo 401ks with me at TD. TD has a boilerplate plan. There's not a lot of options and functionality. You can, bells and whistles, you can pick and choose. I don't recall if that plan through TD allows the rolling in of other IRAs. I want to say it doesn't, but I don't know. And if it does, I don't know if it would allow the separation of pre and post-tax money. So the answer is it all depends. You'd have to look at the solo 401k plan and what that custodian allows. They may not. Facebook user believes the disclaimer trust has to do with inheriting an IRA, for example, and individual disclaims all or part of that amount. Yeah, I know if you're an IRA beneficiary, even named as an individual, you're allowed to disclaim it. So if there's, whatever, 2 beneficiaries, I'm one of them. I can say, I don't really need the money. I don't want it. Let me disclaim it. Give my portion instead to the other beneficiary. So that's able to be done. You don't need a special disclaimer trust to do that. But I'm just thinking out loud. Maybe a disclaimer trust does some way facilitate the transferring of an IRA upon death. I really don't know. I'm going to have to look into this now. I'm curious. All right. What's this? Eddie Martin, I roll over my 401k Roth contributions annually into my Roth IRA. Does each rollover have its 5-year rule? I'm doing this on both 401k Roth contributions as well as the after-tax contributions that are automatically get in plan conversion to the Roth bucket. That's a good one. So what I'm thinking, what I'm hung up on in my head is that the clock of your Roth IRA is independent of the clock of your Roth 401k. So if you opened your first Roth IRA 10 years ago, all your Roth IRAs from this point forward meet that clock. The clock of the Roth 401k is separate. You have to meet 5 years of that separate to take distributions from that. What I don't know is conversions. This is where it can get sticky. So the contributions you make to your Roth 401k, to roll them into your Roth IRA, they will be deemed as if they were contributions into your Roth IRA from the get-go. And so long as your Roth IRA is already 5 years old, you're fine. Those contributions keep their characterization such that when you roll them from your Roth 401 to your Roth IRA, it's like they were contributed into your Roth IRA all the while. It's the conversions I'm not sure about. When you do a conversion within your 401k of after-tax contributions to Roth 401k, and then roll those over to your Roth IRA, that's what I'm not sure about. I'd say to be safe, just try to not touch those monies for at least 5 years if you can. But I don't know the answer to this. Good question, Eddie. Sorry. All right, final comment from what I see. If the 401k states that they only allow pre-tax funds in the reverse rollover, then does that mean it can't be used to extract the coffee from the cream? I.e., the IRA can't send only the coffee. The 401k has to accept both and sort it out. Ooh, yeah, I don't know. The plot thickens. I don't know if that means you flat out can't do it, or you can, and the 401k will only take the pre-tax, which means you're filtering out and leaving behind only the basis or the after-tax in your IRA. It will be awesome if that's the case. That's a real nice way to sift them out, but I don't know the answer to that. I'd say ask the 401k custodian or administrator and ask the IRA custodian, but I don't know that they know the answer. Either of them would know the answer to this. They should, but you may have to ask a few people. So I don't know. Great thought, but I'm not sure what the answer is on this. If you open a Roth IRA after 59 and a half, does the 5-year rule still apply? Yes, it does. So in order for Roth IRA distributions to be quote unquote qualified, 2 things need to happen. 1, your first Roth IRA needs to be open and funded at least 5 years ago, starting January 1st of the year you opened and funded it. That always applies. The second one is you need to be at least 59 and a half, or there's a series of other exceptions, but typically those 2 are it. So let's say you're 60. You've never had a Roth IRA before in your life. You open one today. You can always take out your contributions. So if you start putting money in this year and every year thereafter, you can always take out the amount of your contributions. You can't take out the earnings until you've met that 5-year rule. So if you start it today, May 19th, 2021, your 5-year clock starts January 1st of this year. So you have to wait 2021, 22, 23, 24, 25. It's not until January 1st, 2026 that you will have met the 5-year rule. Only then can you start taking out the gains tax-free as well. Now, because you're over 59 and a half, there's no 10% penalty, even if you don't wait to 5 years. You can take out gains with no penalty, but there will be tax on the gains if you don't wait those 5 years. Make sense? Hopefully. All right. Looks like we're done. Yes. So that's it. So thank you all. Next week's live, I'm looking forward to this one. It's going to be a live demo of me doing a financial plan in my financial planning software called eMoney. Not quite sure what I expect people to get out of it. I just thought it'd be cool because people, you may come across other groups or sites or advisors saying it'd be good if you had a quote unquote a plan. So I wanted to show what is a plan. And the best way to show it is to actually demonstrate one. So I'm going to come up with a fake couple, make up some numbers, and just show what it is, show kind of how it's used practically, in my business and presumably other advisors' businesses. The plan is the starting point of our relationships to figure out the tax planning and the distribution planning and the what should I do or how are my investments properly allocated and whatever. So that'll be next week. Look forward to that. Until then, I will see you, and hopefully good time in Texas this weekend with Cody Garrett. We will be sure to get a picture to share with the group. All right, take care. See you all next week.